Inflation is dominating the headline news outside China. Central bankers are raising interest rates to bring down inflation that has reached unprecedented levels not seen in the past few decades. What is the situation in China? How are the Chinese policymakers responding?
China is keeping inflation under control, unlike the rest of the world. In May, the Consumer Price Index, or CPI, was up 2.1% in China, which was in line with the government's full-year target of below 3%. In contrast, the rest of the world is suffering from the high inflation. In May, CPI was 8.6% in the US and 8.1% in Europe. We believe CPI is low in China for three reasons. First is a difference in the CPI compositions. In China, policymaker allocates a higher weighting on the consumable goods, such as food and clothing. For example, The Economist estimates food has a 30% weighting in China's CPI calculation, but only 14% in the US. In contrast, China has a lower weighting on the service sector's consumptions, such as rent and transport. For example, rent has a 32% weighting in the US CPI calculation, but only 16% in China. The second reason driving China's CPI low is because Chinese government didn't print the money as much as the rest of the world did. CPI is known as a lagging macro indicator. Today's CPI is a result of the macro policy set 12 to 24 months ago. If we dial the clock back to 2020-2021, the policymakers outside China were printing money at full speed. They believed in the modern monetary theory, or MMT, that printing money would not result in the higher inflation. Back then, their concern was the deflation risk. In contrast, Chinese central bankers didn't pump excessive liquidity into the market. The third reason is a difference in supply-demand dynamics. Since March 2022, several major cities in China, including Shenzhen and Shanghai, introduced the COVID lockdown policies. In contrast, people living outside China had their life gradually back to normal. As a result, if we think about the supply and demand dynamics, consumer demand has been weak in China since people are locked in their home, but strong outside China, driven by a phenomenon known as retaliatory consumption. We still believe China will keep its accommodative monetary policy. US and Chinese economic and policy cycles are not in sync. The US central bankers are accelerating the speed to raise interest rate to cool down the economy and bring inflation under control by slowing down the demand for goods and services. In contrast, Chinese policymakers still aim for a 5.5% GDP growth for 2022 versus a low single-digit run rate. They're likely to keep an accommodative monetary policy and introduce fiscal policies such as infrastructure spending to accelerate the growth.
Can you please give us an updated equity outlook for the Chinese equity markets compared to our January episode?
As you know, we don't do market timing at HSZ Group. We believe that Chinese equities warrant a solid and permanent standalone allocations in any diversified portfolios, as it improves the risk-return characteristics and allows investors to benefit from the growth of the second largest economy in the world. In our January episode, we discussed three main factors that could work in favor of the Chinese equity market in 2022. The first is that China is the only major economy in the world that will be able to cut interest rates. Second, Chinese companies are improving capital allocation policies. And third, Chinese equities are attractively valued. We believe all three factors listed above still hold and remain positive for Chinese equities. The real interest rate in China fell from 1.8% in January to 0.7% as of May. The companies listed in the Hong Kong Stock Exchange alone has spent $3.4 billion on the share repurchases in the last 6 months. The 12 months forward price to earnings ratio of the MSCI China is 12 times. At HSC, we actively monitor our portfolio's margin of safety. We measure the difference between our own valuation and the current share price. A high positive margin of safety indicates a high potential for share price appreciation over time. Currently, our portfolio's weighted margin of safety is 83%. The HSC China Fund's ambition is to hold the best 25 Chinese companies based on their inner strengths, valuation, and relative attractiveness. We will continue to look for opportunities which best fit our investment criteria. We remind the investor that the secret sauce to success is through long-term investment.
That's it for today. Thank you for watching and hope to see you again in the next episode.